Hello everyone. Before we dive into our main case studies on capital budgeting, we're going to take a few moments to cover some of the foundational concepts that power the net present value method. This will be a quick catch-up on the time value of money and discount rates to ensure we all have the same solid footing as we move forward. The entire basis of modern finance rests on one simple but powerful idea: the time value of money. To understand this, ask yourself a simple question. If someone offered you $1,000 today, or the exact same $1,000 1 year from now, which would you choose? You'd choose the money today, and for a few good reasons. First is the opportunity to invest. You could take that $1,000 today and invest it, allowing it to grow to be worth more than $1,000 in a year. Not having the money now means you lose that opportunity. Second, there's inflation. Due to rising prices, $1,000 will likely buy you less a year from now than it can today. And finally, there's always some element of risk that you might not receive the money promised in the future. The key takeaway is that money has a time value. To make sound financial decisions, we need a way to compare money from different time periods on an equal footing. So, how do we compare money across time? We use a process called discounting. Discounting allows us to calculate the present value, or PV, of a future amount of money. It's how we figure out what a future cash flow is actually worth to us today. The basic concept is captured in this formula. The present value equals the future value divided by the sum of 1 plus the discount rate raised to the power of the number of periods. The future value is the amount of money you expect to receive in the future. The number of periods is how long you'll wait, usually in years. And the discount rate is the rate of return you could earn on another investment of similar risk. This formula is what allows us to translate all future cash flows back into today's dollars, making them comparable. Now, the time in time value of money is so critical because of a powerful effect called compounding. Compounding is the process where you earn a return not just on your initial investment, but also on the accumulated returns from previous periods. Let's look at a simple example. Imagine you invest $100 at a 10% annual interest rate. After the first year, you earn $10 in interest, bringing your balance to $110. In the second year, you earn 10% on that entire $110 balance, which is $11. Your new balance is now $121. That extra $1 you earned in the second year is the compounding effect in action. It was a return you earned on your previous return. Because of this, the frequency of compounding, whether it's annual, monthly, or daily, has a significant impact on our calculations. Because compounding can occur over different time frames, there is a critical rule we must follow for all present value calculations. It's the apples to apples rule. The time period of your discount rate must match the time period of your cash flows. So if you have annual cash flows, you must use an annual discount rate. If you have monthly cash flows, you must use a monthly rate. So how to adjust when the periods don't match? Let's say a project has monthly cash flows over 5 years, and your company has a required annual rate of return of 12%. You must adjust both the rate and the number of periods. The new discount rate would be the 12% annual rate divided by 12 months, which gives you 1% per month. The new number of periods would be 5 years times 12 months per year, for a total of 60 months. The key takeaway is to always check that your periods and your rate are aligned before you begin any calculation. The discount rate is one of the most important inputs in any capital budgeting decision. In this context, it represents the minimum required rate of return that a company expects to earn on an investment. You can think of it as the project's hurdle rate. For a project to be acceptable, it must generate a return that is higher than this rate. It reflects the opportunity cost of investing in one project over another with similar risk. For example, if a company can already earn 12% on a similar investment, it wouldn't accept a new project that only earns 10%. That 12% becomes the minimum acceptable return, or the discount rate. For most corporations, the discount rate is typically based on their overall cost of capital. So where does this rate come from? For most companies, the discount rate used to evaluate projects is their weighted average cost of capital, or WACC. A company raises funds from two main sources, debt and equity. Debt is money borrowed from lenders, like bank loans or bonds. The cost of that debt is the interest rate the company pays, adjusted for any tax savings. Equity is money raised from owners or shareholders. The cost of equity is the return that those shareholders expect to earn on their investment in the company. This expected return is higher than the cost of debt because shareholders take on more risk. WACC simply blends these two costs together based on the company's financing mix. It represents the average rate of return a company must pay its investors, and therefore any new project must earn at least this rate to be considered acceptable. Let's put this all together and see how the discount rate works in practice. The discount rate is used to calculate the discount factor for each year, which we then multiply by that year's future cash flow to find its present value. The formula for the discount factor is 1 divided by the quantity of 1 plus the rate raised to the power of the number of periods. For example, what is the present value of a $1,000 cash inflow that you expect to receive in 2 years if your discount rate is 10%? First, we calculate the discount factor, which comes out to 0.826. Then, we calculate the present value by multiplying the future cash flow of $1,000 by that discount factor, which gives us $826. This means that $1,000 received 2 years from now is only worth $826 in today's money, given that 10% required rate of return. When you see the discount factors used in our upcoming case studies, this is exactly how they are calculated.